The Canadian banks are sitting on incredibly large piles of excess cash, literally billions of dollars in excess cash that has accumulated since 2020. And this is very likely good news for you if you are an investor in one of the Canadian banks. Hey guys, I'm Mrs. Invest. So I'm going to explain why this is good news for us as investors in the Canadian banks. But first, let's backtrack a bit. So in 2020, when everything closed down, the banks started stockpiling extra money in anticipation of people and businesses defaulting on their loans and mortgages. As well, OSFI, or the Office of the Superintendent of Financial Institutions, mandated and restricted the Canadian banks from raising their dividends to investors and share buybacks. Now, share buybacks are where a company uses excess cash that they have to buy back shares of their own stock, essentially reinvesting in themselves, and it reduces the number of outstanding shares or reduces the supply side of the demand supply for shares of the stock, and it's generally a very good thing for investors and a good thing for the stock price. And a dividend raise is where you, by simply holding shares of the stock, receive more money from the company in the form of a dividend, and you don't have to do anything at all other than hold the stock. And these restrictions are still in place today, and the purpose of them was to make sure the banks had enough cash and enough capital to weather the anticipated financial storm that was coming. But the financial storm that was anticipated never really came. Actually, Canadians saved a record amount of $280 billion last year, whereas we normally save around $10 to $20 billion. And a lot of this had to do with we simply couldn't go out and do anything, and a lot of people were panicked about possibly losing their jobs, so everybody just started hoarding onto their money. And from a savings account perspective, we are actually better off as a whole on the population than before 2020 even began. So what does this all mean? Well, in the banking industry, there's something called a common equity tier 1 ratio, or a CET1 ratio for short. And basically it's a ratio of a bank's capital against its assets. And it's a quick way to measure the liquidity of a bank and their ability to withstand a financial storm. The higher the CET1 ratio number, the better the position the bank is in to weather any kind of financial storm. And the Canadian banks are required to maintain a 9% CET1 ratio. But since 2020, they have blown past that and are on average around 13%, with $80 billion in excess capital just laying around. Now, this is really unheard of for any bank to have this much extra cash really at any point in history. And they batten down the hatches, waiting for this impending wave of financial defaults that never really happened, and now they are sitting on a ton of money. So what are the banks going to do with all this extra money? Well, realistically, there's only a few things they can actually do. They can reinvest the money back into the business for growth, but the banks are quite established. They're not young, early companies, so there's only so much more growth that they could actually do. Or they could use the cash to buy out rival companies. Or third, they could return it to investors in the form of dividend raises and share buybacks. A TD spokesperson said they have enough excess cash to both raise the dividend and make more acquisitions in the US. And RBC has said they have too much cash. So as soon as restrictions are lifted, they plan to buy back shares of stock and increase dividends to their investors. If you watched my video called Dividends Demystified, I'll link it at the top. I talked about the dividend payout ratio. Now, the payout ratio is the percentage of net income that a company earns that it pays back to its shareholders. And the Canadian banks tend to sit at about a 40 to 50% payout ratio. That's where they like to be on average. And they are already well below this 40%, even with the reduced income that they saw in 2020. And since the markets are always forward-looking, earnings are going to be great for the rest of 2021. They're going to be really good and excellent in 2022. And so these payout ratios are going to start to get stupid low, like 30% low. And so there are massive dividend raises on the horizon for Canadian bank investors, and really it's just a matter of when OSFI decides to lift these restrictions of share buybacks and no dividend raises. And I think it could possibly be in the fall, winter, or early in the spring of 2022. Nobody knows exactly when it's going to happen, but what we know for sure is the banks are not going to be sitting on all of this extra capital with a low payout ratio and not returning any of it to investors. And if you were lucky enough to pick up some shares of Canadian banks during the lows of 2020, once these dividend raises come out, your yield on cost is going to be some of the most delicious and spicy yields of our generation. You know, the Canadian banks, if stocks were animals, I think they would be a tortoise. You know, they're not very exciting. They're relatively slow. They're a little bit boring, but they're very steady. They rarely tip over and they get the job done. You know, the tortoise did end up crossing the line. So let's say you haven't invested in the Canadian banks yet. Are they a buy right now? Well, they've run up a lot. They're at all-time highs, and it's been a really solid run up since the lows of 2020. And what I know for sure is, in terms of the share price, nothing goes up straight forever. So I wouldn't be surprised to see a small correction, maybe in the fall or winter, maybe 10%, who knows. But these are things that you cannot predict. You don't know when the little corrections are going to happen. But what we can say with pretty good certainty is if the stock has been running up for months and months and months, probably you may see a little correction happening sometime. You just don't know when it will be. But what I think is more certain is that earnings for the rest of 2021 for the Canadian banks are going to be great. Going into 2022, they're going to be even better. And they're already going into those years with excess cash to begin with. So I think this really bodes well for investors in general. And I'm very excited for when they start to raise the dividend and the restrictions are removed. So I hope you guys enjoyed the video. Let me know and follow me on Twitter if you like, at Mrs. Invest1, and I will see you guys in the next video. Bye.